So, where do you think we are in this economic cycle, Bob? And what do you foresee for the second half of 2023?
Yeah, it's feels like a lifetime ago, right? When we were
Right?
talking in January, and I think the thing that's so interesting about that is when we talked in January, we were talking about a circumstance where we talked a lot about the macro cycle and the macro economy is a very slow moving, is very slow moving. And I think it's pretty interesting to see that, despite the significant monetary tightening that we have seen, basically, first quarter growth came in, net of the inventory dynamic that was going on. First quarter growth, nominal final sales, real final sales, pretty strong, all things considered. Consumer demand, et cetera, all very strong. And so, you put that all together and you sort of say, actually, what we're seeing at a big picture level is we're seeing a late cycle. We're seeing tightening in response to elevated inflation pressures. We're seeing that play out slowly because those sorts of dynamics typically play out slowly. And if anything, what we're seeing is that cycle is playing out more slowly than is normal because what we're having, which is a little different than the last couple of cycles, is we're having very much an income-led growth cycle. And so it's a lot harder to slow down an income-led cycle. Typically, if you see a credit cycle, the way you respond is you tighten interest rates. That starts to change the price of borrowing, and that creates a relatively abrupt slowing in credit. But in an income cycle, the linkages are a lot more difficult. It's a lot harder to create those linkages because what happens is you have to raise interest rates enough in order to depress asset prices enough in order to get a slowing of demand, in order to get a deterioration of profits, in order to get companies to start laying people off, in order to then get easing of pressures on the labor market. And so if we think about that cycle, we really haven't gone very far in that cycle. The first quarter earnings also were like fine, not spectacular, but certainly, down a few percent from a very strong first quarter a year ago is certainly nothing that any company is going to be radically concerned about. And so you sort of see that in some ways, market expectations have flipped, from Goldilocks to higher for longer to deflationary depression to financial crisis to maybe a little higher for longer right now and an AI revolution. Those expectations have moved around all those different phases over the course of the last few months, and the macroeconomy mostly hasn't changed.